Good Tuesday morning and welcome to Opening Bid live from Yahoo Finance's New York City headquarters. I'm Yahoo Finance Executive Editor Brian Sozzi. It's always a little tricky the day after holiday for investors. You don't know if the same narrative that drove stocks pre-holiday will hold into the new week. For example, last week everyone still hated software stocks, but will this week bring out the bottom fishers in these obliterated names? Who knows? But the continued weakness in shares of AI king NVIDIA give me hesitation that the software stock rout is nearing an epic conclusion. Here's where my head is at post-Monday market holiday. All right, it's squarely on the new Bank of America Fund Manager Survey that dropped today. What is this survey, you ask? BofA asks fund managers a lot of questions on stocks and the economy. They get answers, and then they put it all in nice, shiny charts for all of us to consume. The two charts that stood out to me are this. First, this building view on Wall Street. We are on the cusp of an economic boom. AI infrastructure spending is hot. Tax refund season may also be hot. So why not expect an economic boom this year? No, you are already seeing this potential play out in the strong performance of small cap stocks. Small cap stocks are often of companies with outsized U.S. operations. And chart 2 is lingering concern on the explosion of the AI bubble. Ask most folks what an AI bubble is, and they absolutely have no damn clue. It just sounds cool to say, and it sounds like something your portfolio should be absolutely terrified about. Fund managers appear to agree, as they are calling out the AI bubble as the biggest tail risk to markets. Here on my opening bid roundtable for hot takes on all this, Noel Atchison, author of the Crypto is Macro Now Substack, and Yahoo Finance senior reporter Inez Ferre. Good morning to you both. Inez, I want to start with you here on this view that the AI bubble is here, it's now, it's going to explode. Hasn't it already exploded if you're just looking through the prism of software stocks?
I mean, it certainly it has impacted the software stocks, and there is concern that you are seeing a disruption in the software space because of AI, and that's also because, and that also bleeds into other areas of the market as well, other areas of tech. We've seen it with transportation and logistics stocks as well. So. Yes, the market is concerned that you may be seeing a bit of a pop with the AI bubble, but you also have to look at the productivity side of it and what this will do for businesses, productivity-wise, and businesses that are using AI. And this is expected to help their bottom line. I mean, you had Fundstrat that's come out to say it's basically a lower input cost for these companies, which equals more profits for them as well.
Noel, what I find so interesting, it's good to see you again, by the way, it's just the correlation between crypto and these software stocks.
Huge correlation, Ryan. And the fund manager survey, I mean, I haven't actually seen the full report. For some reason, I am not on the Bank of America mailing list.
Well,
but
I need to put you on.
Parsing the media report. No, I wish. I have been parsing the media reports, and what I always look for is signs of sentiment. And there's some heavy contradictions in here. We've got, everyone seems to think we're in the AI bubble, as you rightly pointed out, yet at the same time, everyone's very bullish. And what they seem to be forgetting is that it's the AI sentiment that has driven the index up over the past year. And as we turn into some more conservative names, that generally does not bode well for what's ahead for the stock market. And this is one of the reasons, as you pointed out, keeping crypto prices low. Risk-off sentiment is not good for short-term crypto performance.
Noel, let's just stay on AI for a second, because I want to get into crypto with you, of course. But I just posted a story on Yahoo Finance, just hit like 5 minutes ago, looking at, on the one hand, we've seen this major sell-off in software stocks, but you look at Wall Street profit estimates for software companies, they've actually risen, which is, I don't understand. I mean, at some point, Wall Street has to get it, and they don't seem to get it yet.
Well, but as you know, the old adage is it's not what you buy, it's what you pay. And there is an argument to be made for anything to do with tech having run up, pushing up valuations. Again, there are arguments that valuations are normal given the explosive growth expectations. If you start to doubt those expectations, then obviously your expected price has to come down. But growth in earnings is rearview mirror. What market is looking for now is signs that the capex is going to produce some fruit, and that the disruption to companies, especially the software names, the disruption is not going to cause any hiccups in the bottom line.
And as I'm really of the view that in order for software stocks to bottom, earnings estimates have to bottom, and that has not happened yet.
Well, the word is estimates. Sorry, I thought you were talking to me. Go ahead, Inez. Apologies.
I mean, you're right. Look, there's a type of re-rating of what we're seeing, and expectations have to come down because there is disruption that is going to happen. It doesn't mean necessarily that the whole software sector is going away, but we are seeing also, investors, the market that is also has been expanding into other areas of the industry because it is seeing the sort of that, okay, maybe perhaps tech, software within the tech space. This is a place right now that the market is ignoring. I mean, because you've seen that rotation going into other sectors like energy, like materials, like consumer staples, and the market is sort of hiding out in these other sectors for the time being.
Let's bring in Brent Schutte. He's over at Northwestern Mutual Wealth Management. Brent, good to see you as always. My man, we were having this debate on software stocks, whether to get in there and buy, what's going on with them. We're about 7 days out from earnings out of NVIDIA. If this report is good, doesn't it justify everything we have seen in terms of a sell-off in these software stocks?
I think the big thing that's occurring was where you opened with an economic broadening, and that's where I think the market is starting to broaden out of those AI names that have previously been the only areas in town that actually had earnings growth. You're seeing earnings growth across a broader swath of the economy and a broader swath of the market, which is attracting investors to this rotation theme, which we think continues. And that's where I just think you're seeing that rotation occur, which can be messy. From the standpoint of the software companies and earnings and whatever else there may be, this is where investors have been paying a premium multiple for those. They're crowded trades that people have been moved into for over the past few years as the rest of the economy and the rest of the market kind of languished. And now that they're contemplating what happens going forward, I think investors are thinking about the multiples they're paying for those. And that's where you're seeing multiple compression, which is pulling those stocks down quite a bit.
Brent, I mentioned at the top of the show, this chart came out of compliments from B of A this morning, getting the view that on the street that people are starting to come to this viewpoint that we are nearing an economic boom. Unclear what that actually means. Maybe it's over 5% growth, whatever it is. You can see the chart there on the screen. Are you in the economic boom camp, and do you think this really strong economic growth rate happens starting in the spring as we get those tax refunds?
I think it's more of a broadening. So over the past few years, the economy has pushed forward, but it's been really, really narrow, which has led to that really narrow market that I just talked about. That's where you've seen the impact of higher interest rates on certain segments of the economy and certain segments of the market. Now what you're seeing is that interest rates have moved lower. You've seen the Fed cut rates by 1.75%. You've seen the 10-year Treasury move down to 4%. And that's where, I don't know if it's a boom, I think it's a broadening, where you're going to have those parts that were previously harmed by higher rates start to do just a bit better, and that's attracting investor attention. I do think there is still a risk that is out there that people aren't paying heed to. The reason why rates are going lower is because the labor market is weak. And that's where I don't think I've seen in my 31 years of doing this, people less worried about job growth near zero. And that's where there could be a risk there. That being said, I do think you're referencing the stimulus that's in the pipeline, and that's where I think people are thinking about the stronger growth going forward.
Noel, if I think back to late last year, what drove Bitcoin to record highs? I mean, not what drove it, but it came against this backdrop of middling economic growth. Could Bitcoin come back? Could it retouch those highs this year if the economy is so strong?
It's unlikely, to be honest, in my opinion. Obviously, I would love to be wrong on that. But right now, Bitcoin is seen as a risk asset. If the economy is strong, then liquidity is going to be fairly calm. If liquidity is fairly calm, there are plenty of other speculative assets to put money in. Right now, Bitcoin as a macro asset is competing against all sorts of AI plays, et cetera, et cetera. If you see Bitcoin as a store of value play, then it's competing against gold. But for that, you'd need liquidity to be pushed into the market, and there's no reason to do so if everything is just going great.
What gets Bitcoin moving higher, Noel? What is that right catalyst?
Now, yeah, I've been thinking a lot about that. What is going to stop this downward drift? Right now, liquidity. And we know that of the longer term, debasement is on the table. We're seeing governments around the world ramp up spending. So debasement is inevitable. But liquidity is a different issue. For liquidity to be pushed into the largest financial markets in the world, something has to break, or there has to be some kind of emergency. And we can fervently hope that doesn't happen. We also have to remember, though, that Bitcoin is a global asset, and liquidity around the world right now seems to be tightening, with rate cuts no longer on the table in many of the large economies. So very much it depends on when something breaks, and the authorities have to step in.
Inez, are you in this economic boom camp?
I mean, look, there's a lot of fiscal spending that's going on, and the tax incentives are there. You've got the big, beautiful bill. This is going to be very bullish for companies. There's infrastructure spending. So there's everything that's happening. Yeah, there's a big case to be made for this is a run it hot environment. The question is on the labor side, as was just mentioned earlier, and is this going to be a sort of jobless recovery where you are seeing sort of that jobs are not added to the economy because you have so much productivity coming from AI?
Not bullish for gold. Inez, in that BofA survey, they're saying gold is still, I think for the second consecutive month, one of the most crowded trades in the market.
Yeah, that's right. And look, but you still have Wall Street that is bullish as far as gold, even though we saw the drawdown recently and the volatility that we've seen in gold that has been almost, and silver even more so. But you still have Wall Street that if you're looking at the precious metals, they're still bullish on gold for the end of the year, for the rest of the year, because of, in part, because of central bank buying and also just the geopolitical risk in general. And if the dollar trends lower, then it's likely that you're going to see gold prices higher.
All right, lots more to get to here on the show. Noelle Atchison, good to see you as always. I appreciate it. Brent and Ed, stick with me. Before I head to break, how could I not mention this after perusing X today? Congrats to the UPS driver that escaped 2 wild turkeys. Look at that intense chase on the screen. Wow, I do wonder if those wild turkeys were upset UPS shareholders able to get their gobbles heard. Shares of UPS are down 27% in the past 5 years. FedEx shares are up 42% during that same stretch. That underperformance for UPS is nothing to cluck at. We'll be right back. I didn't want to do a stock of the day on the show today. I had some other ideas top of mind, but I couldn't help myself on this news out of Norwegian Cruise Line. I preface this by saying I went off the rails on this news on my X account this morning, so feel free to head there for an added dose of fun 2-minute analysis. For these purposes, you should know that the former CEO of Subway Restaurants, John Chidsey, is now the new CEO of Norwegian Cruise Line. Can't make this stuff up. Chidsey was a longtime board member, left and then came back to the board in 2025. No idea who Chidsey is? Here he is at Yahoo Finance's Invest Conference in 2023, talking sandwiches.
Let's just start big picture. You came out of your retirement in 2019 to turn Subway around. What made this opportunity worth that?
So I did Burger King. I ran Burger King for 7 or 8 years, which was a turnaround basically. And I wasn't looking for a job. I hadn't worked in I was working, but not in a real job. I always thought Subway was public, and I always said I never wanted to run another public company again, having done that twice. I think we have lots of opportunities that the brand just hasn't focused on, but our product is perfect for it.
So John, you're not retiring again anytime soon?
No, I'm still having fun.
I have to be blunt here. I think this appointment borders on ludicrous. Despite Chidsey having knowledge of Norwegian from his time on the board, it's way different managing a cruise line day to day. It's way different than managing Subway restaurants. Those that win in the cruise line industry are the ones with deep experience and deep relationships. I've learned covering this industry for about 15 years. Norwegian could use a more experienced deckhand as its stock has been pummeled the past 5 years despite strong post-pandemic cruise demand trends. Royal Caribbean is doing cruising better, getting higher income cruisers because of its fancy, huge new ships. Carnival, meanwhile, has become a destination for the youth of America for cheaper packages. That problem is one big party on board. Activist investor Elliott is now on NCLH's deck with a fresh 10% stake and a whole list of improvements it wants to see from Chidsey. It has also blasted the CEO choice, according to a letter Elliott sent Norwegian's board this morning that I checked out. Elliott thinks the stock could rise 159% to $56 if the company makes sweeping changes. Let's get the roundtable to chime in here. Brent Schutte, Inez Ferre, and Brooke DePalma. Brooke, I'm coming to you because you did that interview with Chidsey. You were following Subway. What is he all about?
I mean, this is a gentleman that certainly steps in and looks to turn around a company, and that's really what we're seeing here. With this new pressure, especially from Elliott Investment Management, we need someone who will certainly make changes right away. Based on my coverage of Subway during Chidsey's tenure, this is someone who steps in, ultimately makes changes quickly, and then leads to more profitable growth. We saw Subway start to regain some same-store sales momentum, ultimately get bought out while under his tenure, and certainly this is something that we will look to see in how many changes he'll make quickly as the new CEO of this company. Ultimately, what Wall Street's largely saying here, liking this new announcement, stock is up today, but Citibank largely saying in a note that they really need to sharpen execution, improve performance, and deliver durable long-term value creation. And so certainly that's what the street is looking for today.
Clearly, Norwegian loves its fast food executives. You have John Chidsey now, the CEO of Norwegian. You have former restaurant brand CEO Jose Sill, who I've known for many years. Good guy there. He's still on that board. Brent, do you want to see these type of leaders running a cruise line company, even if Norwegian is seen as some form of value, as Elliott would suggest? I mean, you got to have the right leaders here driving a turnaround, no?
Yeah, I'm probably the wrong person to ask about cruises, given the fact that I've never been on one. I think broader terms, it is refreshing that we're talking about something outside of the technology area. So that would be point number one. I think point number two, leadership can extend across, I think, corporations and companies, and you are talking about consumer demand on both sides of the equation. So not just from the Subway perspective, but also from the Norwegian perspective, which it sounds like to me, based upon your description, which I know nothing about individual stocks, they're kind of stuck in the middle between the higher end consumer and the younger consumer that goes on Carnival Cruise Lines. And so they probably need a strategy refresh, which I assume that a leader can do no matter what industry they have been in the past.
And as you know what Norwegian has to do? They need to open up some Costco's in there and start selling pizza. I mean, that might just be the suggestion, Nez. Come on, get at me.
Look, I mean, the cruise line industry is strong, so the issue seems to be on execution and also the pricing. It seems like they're also trying to get in more families, and when you do that, you are charging more for the adults, but not so much for the kids, and that was sort of peppered into their last earnings call as well. And they had record revenue in the last earnings quarter as well, but it was a miss. Wall Street was expecting more, so perhaps compared to the peers, it's not as great as a performance, especially in an industry that is becoming so innovative, where you have cruise lines that are cruise ships that are themed, that are going skewer towards younger passengers, etc. So this does seem to be a place. This CEO placement seems to be a little bit of a disruption, is sort of in for them to sort of bring in somebody from the outside, even though he's been on the board since 25, not a long time, but nonetheless, it does seem to be sort of, as Brent was alluding to, it is still consumer facing, and perhaps this is the change that they are seeking, something that disrupts what they've been doing.
Well, I'm going on the record here. If I see Subway restaurants on Norwegian Cruise Line, I am never going on these ships, ever, ever, ever. All right, let's keep it on the consumer. Walmart is set to announce earnings later this week. The report will bring two firsts for Walmart. One, it will be the first earnings call led by new Walmart CEO John Furner. And two, it will be the first earnings report for Walmart since it eclipsed a stock market value of $1 trillion. Polymarket odds show an 89% chance of Walmart beating on quarterly earnings. All of this brings up my question of the day. What is the better buy in retail? Walmart with a ton of momentum behind it, or Amazon, which has lost momentum and is firing people en masse? Brooke, I'm coming back to you here because you also cover Walmart.
Oh boy, well, no stock recommendations here, but what I will say is that Walmart over the past few years has really been doubling down to make sure that it drives more profit than it does sales. And that goes to come as it looks to compete ultimately with Amazon when it comes to advertising, especially third-party delivery and that key marketplace that it's really been doubling down on. But now it's kind of funny how you see Amazon mentioning more and more of the consumer on their earnings call, more so than they have in the past, especially when they double down on that perishable foods delivery. And now, when we hear from Walmart, in no means is Walmart building out a data center like Amazon is, but certainly we expect to hear more about how the company is doubling down on that third-party marketplace, that delivery business, and ultimately as well that advertising business, especially around Walmart Connect. And so it goes to show how both of these companies are really driving or looking to compete in the same way and get the consumer who's looking for that last-minute good that maybe they forgot to grab at the grocery store over the weekend.
Brent, if you and I were having this conversation a year ago on Walmart, I would argue that it was a value stock still, despite all of its momentum. But a year later, they've added a ton of sales, a ton of market cap. Is Walmart still a value play, or is Amazon something more fits the bill as a value play here?
Again, I'm not an individual stock analyst, but if I look at the relative PEs, I think one is cheaper quite a bit than the other. And I think that's Amazon, just from a PE perspective. I think the more important thing here is just the state of the U.S. consumer and what Walmart has to say about that. You've seen the savings rate drop to 3.5%, which tells me that consumers are spending out of their savings or spending instead of savings. And that's where I think we're seeing some of those impacts across the economy. And this is something that I am concerned about. I know the high-end consumer has done quite a bit better over the past few years, but if you think about the market right now, it is where the high-end consumer is heavily invested. I believe the households in America have their most exposure to stocks ever going back in history. And this, to me, reminds me a lot of late 1999-2000 period, where the market is now the risk to the economy, not the opposite way. And so this is kind of an area of concern, just watching that consumer spending, what Walmart has to say. But certainly, I don't know that Walmart, at least in my 31 years of doing this and thinking about what value stocks typically are, I don't think just looking at the PE it trades at, it qualifies to me from an overall just definitional perspective of a value stock.
And as last word to you, Walmart, they're going to have to really mess up this year, I think, to get the bulls off of this story. And I don't see them messing up. I mean, the company has a ton of momentum.
It's up 20% year to date, and you've got Amazon that's down 14% year to date. And Walmart's revenue, such a big part of it comes from groceries. And yes, the 100K plus cohort that is increasingly buying at Walmart. And it doesn't have the CapEx spending overhang that Amazon has. So perhaps that's why it's done so well this year.
Great analysis, you all. Have a great rest of the day. I will see you both soon. Appreciate it. And scan the QR code on your screen and check out Yahoo Finance's Prediction Markets Hub, powered by Polymarket. All right, if you aren't paying attention to the companies behind a new wave of AI-driven drug development, you may end up missing out on essential investment opportunities. One company that has caught my attention is Chai Discovery, co-founded in 2024 by Joshua Meyer. After graduating from Harvard, Meyer began working as a researcher at OpenAI during the development of GPT-1 and GPT-2. He then worked at Meta's generative biology group, where he co-led the development of ESM1, the first transformer protein language model. Very complicated stuff. Fresh off a huge capital raise, I caught up with Joshua for a new episode of my Opening Bid Unfiltered podcast. You can watch the episode on Yahoo Finance, YouTube, and all major streaming platforms, or listen in on Spotify, Apple, and Amazon. Julie Hyman has you on the other side of the break.